The latest Case-Shiller numbers have just been released and they reveal that home prices across America have fallen for the sixth consecutive month since peaking in July of last year. Values have gone straight down, falling a total of 4.4%. To many buyers watching this video, this may seem like a small sale, given how much prices have gone up since 2020. However, this decline is not the crash that everyone has been predicting. To put this reality into perspective, let's run through a quick example. Suppose you were looking at a house at the beginning of 2020 that cost $300,000. This same house, using the Case-Shiller index as a baseline, would have grown in value to $435,000 last summer. Even with the current decline in prices, we are far from those pre-pandemic levels that everyone can remember. However, there is good news or bad news depending on which side you are on. While this decline seems insignificant, there is reliable evidence that paints a different story. Home price declines are very rare. Going back to 1987, there have only been 3 instances where we have had 6 straight months of declines. One was in the early 90s during the hidden crash, and of course, the other was in 2008, which was the worst real estate decline since the Great Depression. One thing most buyers simply don't understand is the pace at which real estate changes, whether that's up or down. While it may be frustrating to hear, things don't happen as they do in the movies. During the last crash nearly 15 years ago, things fell apart over a period of years, not days or months. The Case-Shiller peaked in July of 2006 and then fell 32 months in a row before doing a bit of a waving pattern until February of 2012. At this point, it had been 5 years and 7 months since the start of the downturn. The whole crash was a very slow-moving train wreck. Just think about where you were 5 years and 7 months ago. That takes us back to August 2017. Now imagine this whole time prices were declining. This was 2008, and despite this extremely long period of diminishing values, the median price of a home in America only declined by about 27%. So why do I say all that? Part of the reason is to set an expectation. If 2008 was the worst housing crash in modern American history, what can we realistically expect going forward? On this channel, I've gone over many pieces of evidence that show signs that this pattern will continue in the near future. But where will home prices end up? Even if my assumptions are true, and we get another crash, to figure this out, I first created my own graph using FAT data that compares the 2008 downturn to the one that we're currently experiencing. Specifically, I went back 3 years prior to each peak and indexed a peak at 100. As you can see, at this point right here, is where 2008 peaked at, and this point right here is where 2023 peaked. One thing you'll notice is that the run-up to the peak was more extreme this time around. The numbers rapidly jumped up right around here, which coincides with March 2020. Now the important thing to notice about this chart is that it proves that, as things stand today, we are worse off today than in 2008. That's not an exaggeration either. If we zoom in on the peak, you can see that the 6 months following July 2006, which was when the last crash started, we were down around 1.1%. In comparison, today, we find ourselves down 4.